M&A TV is pleased to be joined by Corey Massella, New York office practice leader for Katz, Sapper, and Miller. Thank you so much for being here, Corey.
Thank you very much.
Tell us a little bit about your company and specifically what you do.
Okay, so our company is Katz, Sapper, and Miller. We're a CPA firm with a business advisory practice area. Our business advisory practice area is comprises a very large portion of what the CPA firm does, which is unusual. Our tax and consulting comprises about 60% of what we do. The areas that we handle is true consulting, where we're actually measuring and valuing and negotiating for healthcare practices, valuations, profit centers. But my area of what I focus on is I work on the due diligence areas. I work with the family offices, private equity, alternative investors, and I work on the buy and the sell side of acquiring companies and selling, clearly. The market that we focus on is middle to lower tier. The client, we also sometimes do source deals where we have some of our our clients that we have that actually have matured baby boomers that have gotten to a point where they may go to market and they need to, we bring it and we help to find people, whether it's investment bankers or private equity groups, that may educate them and help them to understand whether there is or isn't an opportunity and what the possibilities are. So one of the biggest areas that we work with is educating clients to integrate an M&A strategy into their business plans and integrate that on an annual basis, which is for most smaller or family-owned businesses, which a lot of them are baby boomers and are aging at this point, they don't realize that they don't have to go and get financing from their banks or dip into their savings to basically build their business and build it larger to exit or seize opportunities that come about, whether it's in the industry and people are struggling, and then they could acquire them with an integration and build something and get economies of scale and bring more money down to the bottom line. There's actually opportunities to go out there and find partners that will support you and ramp you up in an M&A style.
Okay, let's talk about that for a while. So traditionally we've seen most of the activity, and the activity of course is very strong right now in the middle to upper markets. But you mentioned the lower markets, which you also deal with. Why do you think that it has been sort of a little bit of a disconnect there?
The disconnect is because it's actually a little more painful for the acquirers in the lower end of the market, because
How so?
Because most of these family-owned businesses, their driver is really tax-oriented. So they want to pay the least amount of taxes because they're profitable, they're making money, but they don't want to pay taxes. When you get a sophisticated investor walking in, they want to know what the true profits are. And there's a divergence between true profits and tax profits, because tax profits they're lowering the number as low as they can. But the reality is, when you measure a company, you're trying to get what the actual profits are, called accrual-based, generally accepted accounting principles. But you're trying to measure, like, for instance, a company that is a service provider. A service provider provides services, but they don't necessarily bill it immediately, and they've earned the income, they've had people work on it, but they don't report it for taxes immediately until they actually do cash collections. They may just be a cash basis. But the acquirers want to know what the real earnings were year to year, because you can have swings up and down in projects. So I've had situations where I've had companies that, they were doing about $35, $40 million in revenue, and they were representing to potential buyers that they had a 10% growth, 13 to 14. When we went in there and actually did the real numbers, it was 0.
Oh no.
So, which was not a good representation. Right. You don't want to be there. But the point is that it's the investors don't want to go through that long-winded process. Start with somebody who hasn't gotten it together before they start to dance with them and bring it to market.
Sounds tedious.
It is.
To get it to that point.
Yes.
Okay, so we have talked about how the activity has been pretty robust so far. recently over the last year or so. What do you think going forward the rest of 2016 into 2017?
I think that you were going to have 16 is going to be strong. However, I think there's going to be challenges on the EBITDA multiples because there's already starting to be a little bit of a pushback on the leverage by the institutions because there's concerns about the valuations and the interest rates too, and the stock market isn't helping either. So we're already starting to see where there's pushback on the amount that the alternative financing or banks or anybody is willing to leverage on the deals, which is going to be a pushback on the valuations when there's an acquisition.
What sectors do you think will remain the strongest?
I think that brick and mortar is always going to be strong. Technology's still going to be out there because technology is baked into everything that goes on. But I think the biggest area is going to be the acquisitions are going to be mostly focused on strategic acquisitions, roll-ups of industries. I think that I think the build and buy is slowing down. No one's buying to build and buy in the mid to lower. They're really going out there and they've got their anchors and they're building and they're buying and adding additions to their anchor clients. So,
Corey, thank you so much for your insight. It was great to have you as
Thank you.
always here on
Thank you so
MMA TV.
much.